Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and what a turbulent night in New York it was. If you were day trading in New York as I was, you would have seen an immediate, very sharp rally on Powell's initial comments, Chairman Powell of the Federal Reserve Bank's initial comments, and then you would have seen a giving up of that rally and a move to a new low from where the market was before the speech started, and very heavy price action down there for a half hour, looking like it was going to collapse again. But still, yet again, the market moved higher. Now, it looked like almost a single large entity just moved into the market and started buying again. And I've spoken about this before, and I think there has been a very significant large portfolio shift somewhere, or one of the major US funds deciding to get back into the market with a vengeance. And that's definitely been driving prices higher, which is great for you bulls out there. But it's also created this kind of very volatile market where markets sell off on bearish developments, bearish news, only to magically rise up again and even go to new highs on quite several occasions. So this makes the trading scenario for both bulls and bears difficult, because the bulls get excited about the upside, but then there are these deep pullbacks, and then the bears get excited about the downside, and then there's these huge rallies. But I would suggest to you that my scenario that I mapped out post the Federal Reserve rate hike of last week, which was that we are seeing a top in equities here, as markets generally and market participants generally accept now, after that rally after Powell's comments on the day of the interest rate hike, where everyone tried to take his disinflationary comments as his central message, which was really quite amusing. But that's what a lot of the mainstream media did, and a lot of traders, investors did. And his core message was at all times, rates are going a lot higher. At least a couple more hikes, his exact words. And that's at least, that's not the only. And at his comments yesterday in New York, he again reiterated the same themes. That yes, there are disinflationary pressure events happening, but they're in their very early stages. The Fed's job isn't done. And in fact, if the jobs data stays very strong, the terminal rate, or the end rate where the Federal Reserve will stop hiking, is probably higher than he had previously thought. So much for the pivot. Why do I have to keep talking about it? I said I'd never use the word again, but everyone else keeps believing in this thing that's always been a fairy tale. A complete nonsense. It's a mock-up idea to generate volatility, which is great for financial institutions and the media, to have people excited one way and then excited the other way. There was never going to be a pivot. There isn't going to be a pivot. Federal Reserve interest rates are going up at least 2 more times, the Fed said. I'm saying 4 more times. So that's another 100 points from where we are for the Fed funds rate. But at a minimum 50, most likely 100. And there's even risk that we get 6 more interest rate hikes of 25 points this year. Inflation is simply too high. It doesn't matter if it's lower than the previous month. It's still far too high, and it has to be complete. So basically, the thinking of central banks, and Governor Lowe mentioned this, or the RBA statement mentioned this yesterday when the RBA raised rates by 25 points. The thinking in the central banks is that if inflation stays high for too long, then consumers and businesses get used to the idea there's going to be high inflation going forward, and their behavior becomes changed because of that belief. So as well as all the true economic problems being created by inflation in the first place, they don't want, like they're desperately fearful of consumers and businesses starting to believe that inflation will continue. That's why they will aggressively keep hiking rates until it's slammed back down. They're not interested in inflation coming back down slowly. They're trying to slam it back down before, in central bank speak, before it becomes anchored in the minds of consumers and business managers. So that's why rates keep going up. And the central banks are being given carte blanche to keep doing this by the fact that their other mandate, which is to keep strong employment as much as possible, looks fine on the superficial data releases. But of course, in the United States, there's 2.6 million fewer workers, and that's why it looks like it's such low unemployment. If you added 2.6 million into the unemployed number, it'd be way up. But, those workers left during COVID and they haven't come back. So it's not the same economy that it was on the employment front. But from the central bankers' point of view, the strong employment numbers say you can keep hiking rates for as long as you want because you're not even impacting employment yet. So that's why interest rates are going a lot higher. Now, the market seems besotted with the idea that it can believe whatever it wants to believe and therefore spin and justify any kind of big trading excitement that it wants to spin on any particular day. But the reality is central banks are about the real world economy, real world inflation, real world employment long before they think about markets. It's really egotistical of a lot of people in financial markets. They think the central bank is really dependent on them. No, it's looking at the economy and it will decide what it thinks it should do with interest rates, regardless of markets. If there was a market catastrophe, it might respond, but not if inflation was high. It wouldn't respond to support the market in a high inflation environment. So it wants to be able to do that should it ever be needed, but it can't do that at the moment. Another reason why it has to get inflation down. But markets are not the central bank's primary concern. The economy, employment, inflation are. At the moment, and they're prepared to have and sometimes even desire economic pain to solve the problem of inflation. So economies running reasonably or slowing, that's fine for them. Employment data looking strong. That's they can do whatever they want to fight inflation. So interest rates are going a lot higher. There's no doubt about it. And the market's priced in a pivot. What a nonsense. That's why I feel equities are highly exposed. That's why I feel the US dollar can have a bounce, because people were pricing into the US dollar that it was going to have rate cuts, and it's not going to have rate cuts. So, and the other thing is when the Fed finishes hiking, which is going to be anywhere between, at least 5.25, probably 5.75, but even as high as 6.25. Initially, I thought it would be 6.5, 7.5. We might get to 6.25, and I made that forecast when everyone thought the Fed was going to stop at 3.5%. So I'm sort of been on track rather nicely in saying interest rates go a lot higher for a lot longer. I think I was using that phrase before the Fed was. The thing is, when they finish hiking, wherever that terminal rate is, it stays there for 18 months, 2 years. It doesn't move. It's the new neutral. So there's no cutting of rates. It's a nonsense. People think the previous decade was normal. The previous 5 years to 10 years was normal. No, it was a complete aberration in history of low rates, low inflation. It was not normal. When going back to normal is higher rates. What don't people understand about that? Okay, so a lot of volatility, but still I think I'm a seller up here. I'll try to sell the rallies, somehow dilute the impact of the volatility. The US dollar, I think, is a buy, so I think the euro and the Aussie dollar are a sell. Gold is kind of neutral. I do like buying oil, but otherwise it's all about high volatility, therefore lower positions, wider stops in order to stay in these markets from a trading perspective. But certainly on the economic front, from the RBA yesterday to we're going to see a lot more rate hikes from the RBA. We're going to see 4-6 rate hikes from the RBA easily. I mean, since they dropped from 50 to 25, inflation has skyrocketed. So they're obviously the RBA got that wrong as well. I'm not going to go into that, but they're not exactly the world's best central bank. But the outlook for Australian equities, given that the RBA will probably hike another 4 to 6 times, even though all the spin in the media is about how, no, they're almost done, it's the same thing. It's people not understanding. Central banks are not about the financial markets. Have a great day. Thank you very much. Clifford Bennett.